In the 1800s, a simple farmer, who knew nothing about Wall Street, stumbled upon an investment strategy so powerful, it's still making people rich today. He wasn't a banker. He wasn't an economist. He was just a guy trying to survive. Yet his accidental discovery is the key to building wealth in the stock market. What was his secret? And how can you use it to grow your portfolio? Stick around, because this story might change the way you invest forever. Back in the 1800s, there was a farmer, let's call him Thomas, who lived in the Midwest. Like most farmers, he faced constant uncertainty. Weather, crops, and prices could change overnight. A bad season meant financial disaster. To protect himself, Thomas had a simple rule. Every time he had a big harvest, he didn't spend all his profits. Instead, he saved some grain for the future, just in case the next year was bad. And when his neighbors had a rough season, he'd sell his extra grain at higher prices. Without realizing it, Thomas was mastering a principle that would become one of the greatest investment strategies of all time. At first, his neighbors laughed at him. Why not just sell everything now? They'd say. But then, a drought hit. Crops failed, and food became scarce. Prices skyrocketed. Suddenly, those same neighbors were struggling, but Thomas? He had a stockpile of grain and was able to sell it for 10x the usual price. By the time the next harvest came around, Thomas had built real wealth, just by doing the opposite of what everyone else was doing. Now, what does a farmer from the 1800s have to do with the stock market? Simple. He was using the perfect investment strategy: buy low, sell high. Thomas unknowingly followed these principles. Save during the good times. Just like investing in stocks during bull markets. Hold assets when others panic. Like buying undervalued stocks during recessions. Sell when demand is high. Just like taking profits in a market bubble. This is exactly what legendary investors like Warren Buffett and Charlie Munger do. They buy when everyone is fearful and sell when everyone is greedy. Fast forward to today, and this simple farming principle is still making people rich. Investors who bought during the 2008 crash made massive returns when the market recovered. Those who invested in tech stocks in the early 2000s, when everyone doubted them, saw insane gains. And people who buy undervalued stocks today are setting themselves up for success in the future. Thomas didn't know what contrarian investing was, but he was a master of it. So, what's the lesson here? The best investment opportunities don't come when things are easy. They come when everyone else is panicking. The next time the market crashes, ask yourself, am I acting like Thomas, or am I following the crowd? If you found this story helpful, hit that like button, subscribe, and drop a comment. What's the best contrarian investment you've ever made? Let's talk about it.